We're going to get started on the next panel, and that's going to discuss emerging strategies and manager selection. As I said earlier, there's been a reemergence in Austin of venture capital. One of my favorite spaces are people who are in private equity, who are either search funds or else who are working as pledge funds or as independent deal sponsors. So we're lucky to have on our next panel, which is going to be led by Robert Butler. Robert, you can wave hi to everybody. Robert he's actually one of my favorite Austin guys, but he's in Arizona today. Robert's going to be leading the discussion. So one of the questions has been asked is, how do you do due diligence on a fund or on an investment when you can't actually be there physically? I think that's going to be changing in the near future, but Dee Smith, I think, is going to be answering parts of that question. So I'm looking forward to Dee's contribution. And then Scott from Jackson Walker also will be addressing some of the legal aspects of it, what he's seeing in terms of fund formation, new managers, different strategies. And again, this whole SPAC thing is kind of mind-boggling. I guess in the old days, SPACs used to be called blank check companies. So looking forward to everybody's comments. Robert, can you speak up?
Can you?
Oh, okay. Perfect, great. Okay, so we're good to go. Robert, take over.
Well, you took some of my my intro away, but I guess to set the scene, as Marty said, like I am usually based in Austin, but I'm hiding out in Tucson right now during COVID summer. I think I've done like 30 or so of these conferences, but this is definitely my first virtual moderating, so excited about that. As Marty mentioned, our panel is emerging strategies and manager selection. I usually work with investors on helping them to source and evaluate investments, and have done a lot of due diligence work. So I'm happy to have both Dee Smith and Scott on this panel to kind of help dive deeper into the due diligence, and then also Dan from Bridgepeak Partners to talk to us, more specifically about what they're seeing in the software space. But to kick it off, I'd like to have everyone just kind of give their brief background on themselves and their firm, how they normally interact with offices, and then kind of dive into some Q&A and hopefully have a pretty interactive discussion. And then full disclosure, I'm an independent consultant, but I'm currently working with Dee Smith. So maybe Dee, I'll let you kick it off with kind of your brief background.
Sure, thank you very much. Can you hear me?
Yep.
Okay, good. So I am based in Fort Worth, Texas, although I'm hiding out in Santa Fe, New Mexico right now to escape both the heat of the temperature and the heat of the COVID in Texas. But in any event, I run a company, founded and run a company called Strategic Insight Group, and we are a private intelligence company focused on the needs of investors, mostly large investors. What we do is perform pre-transactional intelligence on targets of investment, as well as post-transactional intelligence to monitor things. And we call it a vertical or diligence or vertical intelligence process, which at the granular level, it looks at very deep dives into the backgrounds of key people and entities that are associated with targets of investment, to make sure that we help clients understand any negatives, and particularly any unstated negatives, things that people may not want you to know or may not expect you to know, but that you need to know before you make an investment. And then we look at market factors in terms of what claims are made about markets and whether those can be substantiated on an independent basis, on up to political and geopolitical risk. But what's changed, and we're in our 25th year, so we've done this, and we have a lot of large clients. Two of the world's largest investors are clients of ours on an ongoing basis. Many funds of various kinds, private equity, hedge funds, family offices, and so forth. What's changed in the last few months is that the dynamic of the risk equation has become very much different from anything in living memory. Partly that's because of COVID, but it's also because COVID has exposed how fragile a lot of the systems we have are, and how a change that can occur very rapidly can shift the dynamics in such a pronounced way that nothing is the same. And, you know, I think that was difficult to get across. I actually spent some time about 3 years ago working on a television series called A World on the Brink, and that was really the whole point of it, was that we were at the brink of these very large potential changes. And it was very difficult to get people to believe that. But now I think people have fully taken it on board, that you can be a business with a great plan for the year and looking like you're going to have a fantastic year in 2020 in January, like the airline business, for example, and then come, you know, a couple of months later and it all falls apart. So how do you deal with that from the standpoint of an investor in a world that is so tightly knit, so tightly coupled is the term they use for that these changes ricochet and create massive dislocations that are not predictable. And so there are many things to answer that question, but one point I would want to hone in on in terms of due diligence is that investors cannot now go visit the potential targets of investment the way they used to. They can't kick the tires the way they used to. We've heard something earlier today about what the effects of this may be. There are ways around that. You may end up with a situation where, you know, you do remote due diligence, which is something that we're working on now, that we really had not done I mean remote operational due diligence, where a lot of the functions that used to require being on site can be done remotely. And particularly if, you know, the Strategic Insight Group has on the ground teams in over 100 countries around the world, and more cities than that. So we can place local people who are independent and research oriented into a family office, and I mean into a target of acquisition, a fund, hedge fund, whatever, and do a lot of this. And then you may supplement that with a much shorter period of actually meeting people. I think it's right that a lot of things that you want to invest in, you would want to actually meet the people, but it may be outside like this in a restaurant over a shorter period of time. And there are other kinds of virtuality that can be used. But I think the point being that we're in a change situation in which the new normal is never, I think, going to revert to the old normal. For example, I have a long-term client, a fairly good-sized hedge fund. Sorry, go ahead.
Well, I want to get into all these details with everybody, but I want to give a chance to the other
sorry. No.
do their intro. But sorry to cut you off. And then Scott, I see you're there, obviously in Austin. Can you give us a little bit more about your background and current role and how you're working with investors, especially family offices?
Sure. And for those of you who've been with us the whole time, you've already heard all this, but I'm Scott Juskevich, partner at Jackson Walker in Austin. I lead our investor side alternative investing practice. I represent primarily public pensions, university endowments, sovereign wealth funds, and family offices, along with some other folks as well. And mostly what I do is I do the legal due diligence, and in some cases negotiation as well, with respect to private equity funds, real estate funds, hedge funds, separately managed accounts, infrastructure funds, credit, tons of credit funds lately, last few years. Basically any sort of alternative investing, primarily funds-based, but not exclusively funds-based.
All right. You, and then Dan, are you with us from Ridge Peak?
Yep. Hey, everybody. Thanks, Robert, for mediating. Great to meet everybody virtually who's dialed in. Dan Santoro, I'm one of the founders of Ridge Peak Partners. We are a private equity firm here in Austin that concentrates on software and technology-enabled services businesses, and we operate as an independent sponsor. So we're very frequently working with folks in the family office space, and many comprise our base of limited partners on the investments that we make.
I've got a bunch of questions for everyone, and obviously, I think Dan, your role is a little bit different, where I think Dee and Scott kind of overlap some on the due diligence side. But I'm wondering, Dan, like, how are you currently sourcing your investment opportunities, and how have you seen that change in the, I guess we're not post-COVID yet, in the current COVID environment? And then additionally, if you have any thoughts that were triggered from the earlier discussions about opportunities around the space where I think you guys focus.
Sure. So our sourcing model has not been heavily impacted by COVID because we do a lot of what I call proprietary sourcing, which includes things like cold calls into founders or direct emails. And so we don't typically play at all in sell side banked auctions. We prefer to find off market opportunities. We think that those tend to facilitate better investment prospects and enable us to hit our returns a little bit better. And we also don't like to be forced buyers in an auction. So that part, I think, has remained about the same. Something that Dee said earlier, though, on just COVID and its impacts on diligence, that's certainly been something that we've seen. Because most of the opportunities we evaluate are software and don't require us to come on site and do diligence in things like warehouses or to check inventory levels. A lot of our diligence process can be done remotely. That said, one of the challenges we're working through now is how to really build rapport with founding teams over Zoom. How can you really get confident that you can back a team without spending a lot of time with them in person? And that's a dynamic question that we're trying to do our best with in real time.
Well, I'm curious on, you mentioned making cold calls to founders. Has that gotten easier or more challenging in this environment? Because I've noticed some people seem more agreeable to getting on the phone because it just changes up your day. And hey, maybe it's somebody I haven't talked to, so I've got the time because I'm not traveling. I mean, has it gone better or has it been more challenging, currently?
It's interesting. I would say in March and April timeframe, when all of this was coming to light and nobody knew exactly what the next 12 to 18 months would look like, it was a really scary time for a lot of founders. And they were most focused on just keeping the wheels on the train and shoring up their finances. As we've settled into what seems like a prolonged COVID environment where businesses are going to have to figure out how to operate and remain viable, we have seen an uptick in both deal flow and just overall receptivity to speaking with investors who we reach out to cold. And so that's maybe one of the silver linings that we've seen in this environment.
Well, and Scott, kicking it back over to I'm curious as far as like, what have you been seeing sort of activity wise? Is any new areas of interest in your clients that you're working with? And then related to that, in addition to the new sort of investment areas, any new structures that are becoming more popular or less popular?
Sure. Primarily what we're seeing is a carryover from what was going on before, and that's a disproportionately large number of credit funds and private credit. The thing that's a little bit different with the COVID situation going on is new funds being created before they were scheduled to be created, or special opportunities with managers who might not always play 100% in that space. And so we've had some very rapid turnaround requirements on some opportunities when it looked like the COVID dislocation was going to be very short. Some funds were formed very quickly and were really designed to be one and done closes in the private credit closed-end fund style. We've seen some more TALF work that's really basically asset-backed security investing, but a highly levered strategy, piggybacking off the Federal Reserve program. And just, I guess I'll circle back to, there's still some private equity. A lot of funds have put on hold or have been extending their fundraise cycles as well. So you've got some really hot opportunities or perceived hot opportunities in certain dislocated spaces, sucking sort of the life out of some of the other funds like buyout private equity that in some foreign strategies that were already in process and were struggling to raise their target allocations, and so they've sought extensions on their fundraise periods. And at the same time, you've got these other dislocated strategy funds just popping up. And one thing I just wanted to mention about that, and I don't know if anyone's mentioning this or not, but I thought of the other day was, is there cannibalization going on with these new funds, even from, within their own sponsor family? If there's still dry powder in a credit strategy fund, for example, but because of the dislocation, the manager starts a new dislocated credit fund strategy, is that new fund going to cannibalize deals from the prior fund or from the pre-existing fund? And there's no netting of returns, but typically between the new fund and the prior fund. And so, did you buy in at a high point in a fund that's maybe a year and a half old, and now all these super deals are out there that are going to be moved into this new dislocated fund as opposed to your other fund, and so you're going to take some sizable losses, or at least not have huge gains in your existing fund investment, and then there's going to be huge gains hopefully in this new fund, but they're not going to be netted across the two. And so certainly if you're big enough, something you might want to talk to your sponsors about is sort of netting there, but at least as a diligence standpoint, asking about, was there some overlap in potential deals, or are these completely different strategies? Because if there is overlap, cannibalization is certainly a possibility, and you may actually, you might not have a good choice, but you might be forced into a situation that's really favoring the sponsors from a ultimate carry perspective at the expense of the investors.
So is that how the fund managers are trying to win back some fees after the overall fee compression? I mean, it seems like that's a much better setup for the manager, obviously, than the end investor.
Yeah, it certainly could be. I honestly don't know if this is intentional or not. And some of this is, I'm sure, perfectly fine in different skill sets, different people, different strategies. But I suspect that at least some of it is not. And it could very well be a way of gaming the fee system a little bit. On that point, just real quickly, one of the other things that I'm seeing, and this is also a continuation of what was occurring before, but I've seen more of since COVID, is tinkering around with the fee structure, and in particular the management fee structure, not so much the carry structure, but we're starting to see quite a bit more of playing around with what the management fee base is, that upon which the management fee is charged. So typically in a closed-end fund, your base will be committed capital to the fund for the investment period, and then after that it will switch to something, usually invested capital, how much money is in the ground. But we're starting to see, and this had started a little bit before, and certainly in credit is a unique animal, but I'm starting to see a real uptick in tinkering with that base, and I, several things that I've seen in the last couple months that I'd never seen before. So that's one thing to really pay attention to as an investor, and if you're not reading the documents yourselves, or if they get really crazy, get some sort of help, because just because a defined term says invested capital as your base doesn't mean it's what you think it means. It could very well include reserved capital for deals, whether or not they're specifically identified. It could include leverage if it's a leveraged strategy. So which normally you wouldn't be thinking that these things would be included. You'd think it's just money in the ground and that's it. So definitely, the devil's in the details. That's why, people like me presumably have jobs to figure out what those devils are and advise our clients. But as a pure economic point, there seems to be a new round of creativity going on, and it's not necessarily in the investor's favor as it was, say, post 2008.
Well, I guess, Dee, back to you, somewhat similar question. Are you seeing either like interest from your clients in new areas based on the type of work they're asking you to do, like looking at more credit funds or looking at more real estate? And then, you know, in this environment, has the type of work you're doing for those clients then been changing?
You know, it's a very good question, and you know, we are seeing a huge uptick in work right now, and we're also introduced in that in terms of our general work, which is pre-transactional. There are a number of our clients who are using various strategies, delving into new strategies, looking at opportunities, distressed opportunities, for example, of various kinds. Also looking at things that they put on hold for a while and bringing those back. I think that there is, you know, the fiduciary duty of large investors, of institutional investors, which are a you know, large part of our client base, to produce above market returns is something that it has not gone away. And so, you know, the extent to which they can just kick the can down the road, the extent to which they can simply put re-up into existing investments, those things create huge risks because they are you know, concentrating risk by not diversifying, by pulling it in. And they also don't really know, although we're getting some inquiries about how to figure this out, where those companies have risk that has come from COVID that they didn't have before. And the problem with COVID, the COVID pandemic crisis writ large, is that it affects so many things. So, you know, for just to pull a random example, air freight went up dramatically across Trans-Pacific in the you know, within a month of COVID happening, and to the point that you couldn't even get things shipped. You know, surface transportation was not allowed to unload. Well, that has a huge effect on a lot of companies, and so, you know, these risks are so diverse now, and I think people are looking at this from a lot of different standpoints. Of what risk do we have in our current investments? What risk do we have in things that we're looking at? How do we actually thrive in the standpoint of investing in these categories that are doing well and are over invested now, and the price is bid up? There's been a lot of discussion about all of this, but I think in terms of due diligence for new investments, things that you either haven't considered or that you're looking at, it's going to be very different for the reasons that we've all been talking about. But also, I see, and I have for example, a long-term client in New York, a mid-market private equity company. We do transactional intelligence on all their investments. They're continuing to do things. They have not renewed the lease on their. It happened to come up, you know, a couple of months ago. They have vacated their office, given it up. They're working completely virtually and will from now on. So, you know, they'll have a server. And they have a boardroom that some friend has in New York if they need to meet there. But that is an entirely different situation than anybody imagined would happen. And it's not the only example. So I think that, you know, the whole idea of you know, this kind of on-site EDD or operational due diligence is going to undergo a real transformation in terms of funds, and then in terms of operating companies.
Yeah, how do you visit on site if everyone's virtual? You're going to stop by everyone's house.
Exactly.
We did have a question from the audience about pricing for emerging managers. You know, as if you're an allocator investing in an emerging manager, what's kind of your preferred you know, fee structure? And obviously none of us on the panel are big allocator. My quick answer is, if I'd rather do like a seed deal if it's an emerging manager, because you're taking on potentially extra risk. And, you know, if you're a big enough allocator, the fact that you invest is probably going to help them raise future so why not kind of get a piece of that? But I don't know if Scott, you had any thoughts on, fee structure, investing in an emerging manager as a more established, multi-billion-dollar manager.
Well, if it's emerging manager itself as opposed to like emerging markets, there's a lot of flexibility there. We do a lot of work. There's a particular endowment in mind I do a lot of work with that has an entire program set up for emerging managers. There's actually several of them, but this one that I'm thinking of created an LLC, wholly owned LLC, and runs separately managed accounts with all these emerging managers. And you have to be careful not to be too stingy on the fees, because you are usually putting these folks into business or very close to that. So you have to really understand, and quite honestly, those managers need to do their homework on what they really need to keep their offices open. And I'm not sure they always do. A lot of times they're great investors, but they have no clue how to run a business. So the investors may have to help them a little bit with that and not be too stingy. But we do things like, starting off with a management fee, and then there's AUM, like overall AUM tests, and it scales down as the overall AUM, not just with this client, but with all that sponsors clients increases, down all the way to even zero, right, where it just becomes performance fee only. Multi-year crystallization periods, a lot of stuff versus benchmarks, even with long-short managers. A lot of creativity in that space. But again, to me, the critical thing is, have you gotten so greedy as the investor or so stingy that you're actually created an unsustainable platform for that manager? And you also have to think about, talent loss and things like that.
Doesn't it also depend on like the return profile of the fund? So like, at one point in time, the crypto funds were all charging, 3 and 30 or 3 and 40. I just ran across a commodities trading fund yesterday who's charging 40% because they have astronomical returns. I'm not sure how sustainable that is, but
it absolutely does. And part of it depends on, who are these folks and where did they come from, right? Like how long are they really emerging, or is it just that they left some big shop and created their own business, right? But strategy is very important. Some of it's management fee only. You might, if it's a long only strategy, you might pay, 30 bips or something, and that's it. But long short tends to be different. There tends to be performance components. I've done some short only deals, and we had to really think about, how do we pay these guys when they're short only? And really it's just a book of liabilities in a way. So, that requires some out of the box thinking as well. So it's very, very strategy dependent and past performance dependent.
Well, and hey, Dan.
Sorry, Robert, one more second. So I've actually seen some long only strategies, but they're in smaller segments, I guess, like not large equities, but small caps, right? And they seem to charge higher fees as well.
Yeah, that's right. I've done plenty of long only strategies that, if it tends to be, U.S. large cap or something, or Russell 2000 or something, it tends to be management fee only. But once you get into niches, or if you have a long short manager that runs a long strategy alongside of it, or it's the long book that you want to do just the long book, tends to have a performance fee component as well. So yeah, there's no one size fits all. And if you're seeding them, or effectively, you may or may not be taking a piece of the business, or a share of the carry, a revenue share. Even if you're not doing that, if you're effectively putting someone in business, you've got a lot of negotiating leverage to work on those fees. And really, I like that, the one I mentioned earlier, where you start paying off a higher management fee early, and it scales down as the AUM goes up.
Sure.
Really deferring the amount you're going to squeeze these folks, if you will, until they can afford it, really. And then the recognition that you put them into business.
Well, and Dan, I guess pivoting this question a bit for what you guys are doing, are you doing anything differently on the structure of your acquisitions, you know, for like newer software companies versus more established ones? Or do you tend just to look at kind of the same space, so all the structures are the same?
No, it's a good question. It's case by case. At the very least, we're getting a preferred security of some kind, where, you know, in the event of a change of control or a liquidation event in the future, we're the first capital coming out of the waterfall. In this environment, there are interesting opportunities that are abounding because, you know, unless you're a software provider in the remote work tools space, for instance, like a Zoom or Slack, you've seen operating performance fall across the board. And so founders are not necessarily looking to participate in a buyout when they know that valuations have corrected and that their trailing 12-month performance is down. But there are opportunities to do what I would call a toehold investment, where you get in with a, you know, a nominal investment as a minority, with the option to put more capital to work in the coming 12 to 24 months. And so that to me is one of the more interesting places to invest right now.
All right, and then I guess D, sticking with emerging managers on the due diligence side, are there any things that you tend to focus on when you're helping your clients with due diligence in emerging managers versus more established funds? D, still there with us?
Sorry, I had muted myself. Myself. It is different. Although there are things that you do look at, and in particular, you really hone down on the people, because if it's an emerging fund, there's no institutional, there's no what we would call an entity, you know, a company. There's nothing to look at really. What there is to look at is in the background of the people, their experiences, who they've been associated with. So you get these concentric circles, you know, what in terms of people and entities throughout their past. And that can be very, very telling. And what you look for is a pattern of indicators across sectors. So you don't, you know, just to give a very simple example, if you find one thing like a bankruptcy, you know, those things happen. You can drill down on it, find out why it happened. But if you find 2 bankruptcies and 3 really serious lawsuits and 15 traffic tickets, and you begin to get a pattern of behavior, and that, I mean, those are just examples that can be across a whole range of things. That tells you what the character of the person you're dealing with. And really, when you're doing these emerging managers, it's all about the people. The strategy can be brilliant, but if the people are not good, then it's pointless, and you're simply going to face the loss of your entire investment. So, you know, as you move into the more emerging manager element, you also move into looking more at people. Now, having said that, I think you also these days need to look at in the environment that they're operating in, and how, you know, again, with COVID, I think it's changed everything. So you've got, you know, second, third, and fourth order effects of COVID, things that people don't think about that may very, very seriously affect a strategy. And so, you know, you really need to put more thinking into how do we assess the strategy going forward that this emerging manager is talking about in the context of a very changed environment that 6 months ago did not look like it does today. And so, you know, that requires some serious thinking. There are ways to do that, you know, to simulate potential futures and so forth. But I just think that you're really skating on thin ice if you don't take into account the strategies and how they relate to the current and potential future situations of the post-COVID world, you know, as much as you look at the people. So.
Yeah, well, that I think actually is a good transition to, we've had a couple questions about some specific asset classes, and one, you know, directed kind of more to Scott after your comments about seeing so many credit funds. And I guess in what you've seen, is the entire private credit space sort of accounted for, or do you see any areas that are potentially missing, or is it, there's a credit fund for everything already?
Well, I don't think the managers think that that it's saturated yet. Although I do have some clients who are backing out of the space now. They're they all have their own unique needs, but they think that they're invested enough and exposed enough to credit and private credit. But unfortunately, I really couldn't say much more than that because in my role, I'm not identifying investments and I'm not analyzing those investments or the market of investments, but other folks, like some of the folks on this panel, are doing that, and the clients bring them to me, and then at that point, I sort of assess what I have. But I definitely have some clients who feel that they've got enough exposure to credit.
Hey, Robert, I can address that a little bit. We get a lot of phone calls, and I would say that there's a lot of distressed credit. And the question that we asked in the first panel about whether the time is right now or in 6 months has come up a lot. And if you remember the last crisis that we had, it took 2 to 3 years to work out the real estate aspects of it. So it makes a lot of sense to have a lot of different credit structures out there that can handle this. But the timing for working things out, it's going to be a while, I think. Agree with that, Scott?
We were all hopeful this was going to be like a 1 or 2 month blip with a quick return, but it doesn't look like that's going to be the case. So.
Right, and the other side, again, is getting back to this whole thing of like the boomers. And, 10 years ago, or 2008, 12 years ago, the boomers had a lot more time to think about retiring. Now they're mid-retirement age. And so now that they have to really make decisions, like they were pushing things back off, and now they're bellied up to the table as much as possible about what decision will they make, what are they going to pursue, and what credit is available. So that's where the credit comes in from a distress point of view as well. And I'm not sure if you guys are seeing that as well, who are on the video are seeing that as well also, that there's a lot of people who are like, how do I stay in this business? How do I get out of this business? How do I structure things? Is there credit available for me to continue it, et cetera? So.
Well, then I was kind of curious, Dan, have you had any sort of alternative credit providers approach you guys about partnering on some deals or look at kind of creative financing options with your acquisitions?
It hasn't been something that we've had a ton of exposure to, but it makes a lot of sense that that's an area. I think there's opportunity there for sure in our category of the market.
And then there was another question about, have you seen any, interest in agriculture or infrastructure? And so I guess for Scott or Dee, since you're not necessarily sourcing those, but are your clients asking you to look at more opportunities in those spaces? Whoever wants to jump in.
They are asking us to look at we're finding a lot in agriculture and related areas, and again there are these very interesting second, third, and fourth order effects that are relating to those. One is water supply, for example. There's a lot of interest in agricultural production in Latin America and other areas that is feeding into the developed world, so to speak, the large countries' consumer base. And that is something where you're looking at not really so much COVID, but in changed conditions. Because if you're a farmer, farming agricultural company doing large scale farming in some place that's dependent on water from a source like the Himalayas or the Andes, and those glaciers are shrinking, what's the medium term future for that, and what are you going to do to replace it, and do you need to think about where you site it, because it's maybe you need to be near the ocean and you need to put in the money for a desalination plant. There are all these issues that I think we now need to think about as investors that we weren't thinking about in the past, but I think what COVID has done is shown us how quickly conditions can change.
Well, and hey, Marty, we had a request for a question that came in through chat. Somebody asking to be unmuted. I don't know if you saw that.
Robert, I unmuted you, so if you want to speak up, feel free to, Robert.
Great, Marty, can you hear me?
Yes.
Great, thanks. Just a quick question on along the way to be COVID reactive. Have you seen situations where, let's say, there was a fund that was aimed to be hotel, and then because of the COVID restrictions and just for commercial reasons, you want to switch it to partially residential, or likewise certain healthcare applications to be more COVID reactive? Has there been cooperation by some of the LPs or some of the individuals or families going into that strategy? How hard of it is to unwind and change that? I'd be interested in the input to that.
Yeah, we have seen that, and it does relate to these covenants that people undertake, and the what they call strategy drift. And I think one of the family offices can more easily accommodate those changes in strategy. It is there are checks and balances put in place in institutional investors, which make it very difficult. They're intended to make it difficult, and of course, in a time in which you need to be agile, it makes it harder to be able to accomplish that. So yes, we are seeing those sorts of things, and it's and you have if you've got different classes of investors in these opportunities, one kind, like a family office, can very quickly make a decision. Yes, that sounds good, you should change your strategy. Another kind of investor can't, and that can gum up the whole works. So this is something, again, that nobody expected to have to be that fleet of foot. You're seeing that in the energy world. You're seeing it in, as you say, real estate, some other things. Obviously, I can't go into details, but we are seeing that, and it's problematic. And so I don't know what the effects of that. I mean, this would be an interesting question: is what will the effects of the need to be able to do that be downstream? How is that going to change the way this entire dynamic works in this industry?
Well, I think it raises a really interesting question. I mean, most of my time on this topic is spent trying to rein managers in. Hedge funds, for example, have virtually no investment restrictions, and sometimes no investment restrictions. Private equity, infrastructure, venture tend to have some explicit investment restrictions that would prevent certain style drift. Some of it's more implicit. In just, you don't expect an infrastructure fund to be investing in, buyout, right? But it may not even say that in the fund documents. And the interesting experiment or test will be, at least for me, do my clients continue after this to press to rein managers in, or will there be a movement to allow more flexibility, which the managers, of course, love to have, to deal with major events like this that change the opportunity set? Time will tell.
Yeah, I think that. Go ahead.
Well, I was going to say, I wonder if this doesn't apply too much to Dan and what he's doing. If you guys are doing all one-off deals, I'm guessing you don't really drift from the target at that point. But have you seen maybe once you've identified a target, the target company shifting in ways that either you like or don't like, and how have you dealt with that?
Yeah, well, so to take the first part of the question, because we're an independent sponsor, by definition, there's not really dry powder at all in our strategy. Everything that we're going out and securing financing for, we're going to deploy into an investment opportunity. And then in terms of the operating companies that we look at, this is a time for really nimble founders. And I've been impressed to see, for instance, somebody who was in the concert venue space who was pivoting their business model towards more of a technology offering that took advantage of live streaming. And so, if you were to just sit on your hands in the concert environment right now, you're going to be dead in a few more months. And so there's, I think there's certainly a place in this market for a maverick investor to kind of back some of those moonshot ideas and to help a lot of founders through a tough time.
All right, I think we just got about 5 more minutes or so. And so if I don't see any more questions, I'm wondering, if each of you if you have any parting thoughts or words of wisdom, either, I don't know, how you've best adapted to the current situation or seen others do so, or even if you're not investing for yourself, just based on what you've seen, areas that you think make the most sense going forward, kind of open it up. And Dan, you're on my screen. I'll let you go first.
Yeah, I think flexibility and an open mind. For those allocators who have managers that are starting to have strategy drift, I would say it's probably grounds to chat with those individuals about what they're thinking, because maybe there's some merits to that new strategy. But this is a really unprecedented time, and so I think people that are going to be successful in this environment are going to be those that are flexible.
All right, and Scott, any sort of final thoughts, words of wisdom to share with the group?
Read your documents. Don't trust investor representative folks. They'll tell you what you want to hear, not the truth, because they don't even know usually what's actually going on. I'm really looking forward to this. I mean, this is actually, to me, an acceleration of what was happening anyway. I have clients around the world who I've never met, and I work, mostly through the phone, now sometimes through a computer screen. In my role, I never go visit managers. Obviously, if you're doing ODD, that's a little different. But I think we're going to see people can live anywhere after this. You're going to see a lot of managers and certainly their employees moving out of the money centers because they can. And it's going to create some new interesting opportunities in real estate. I think you're going to see some slowing down and maybe depressions in certain really dense areas in the United States, and price increases in a lot of other places as populations move because they now can, which could create some investing opportunities in some areas which you have to watch out for.
Can I just add to that? Because I think that one of the things that Scott didn't mention is I think that the level of due diligence will get deeper that you do through questionnaires and through video, because they're going to have to, right? There's no, in the old days, you would like belly up to somebody you go out to dinner with them, see what their goals are, see what they're about. But I think now it's going to be a lot more drilling down, seeing, get profiling them as best as possible, for lack of a better word. So that's where D comes in.
Yeah.
I have a friend who is also a client, said part of his process was he would never invest in any company unless he could take the CEO out and get him drunk and to see what he was like. But that question aside, this is exactly right. I agree with everything that's been said. I think that we're in a period of radical change, and I think the accelerational aspect of it is enormous. I was on a call, not unlike this, where somebody said, it's as if we've gone from 2020 to 2035 in 2 or 3 months. And I think that's right. And I think that in itself brings unexpected things because we don't really understand how change works. But I think that being fleet of foot, being really able to turn on a dime, both in terms of yourself as an investor, but also in terms of looking at what your invested entities are doing and the ability that they might have to take advantage of things that weren't there a few months ago, and things in 6 months that aren't there now, is going to be absolutely key. So if you're comfortable with change and flexibility, this is an exciting time, and it's going to be a really interesting time. If you're not, then you're going to be in a world of hurt, because that is the world we're in.
All right. Well, and Marty, I think that does it for our panel. So thank you, panelists, and I'll let you take it from here.